Welcome back to Talk Tickers. We're your deep dive into the key takeaways from corporate earnings calls. Today, we are looking very closely at Artivion Inc., that's ticker AORT, specifically their Q2 2025 earnings call. This one dropped after the bell, August 7th, and, well, it definitely made some waves.
Oh, it absolutely did. More than just waves, I'd say, was pivotal. That press release, 4:05 p.m. ET, and the call that followed, it really laid out the case for what turned into a pretty massive market re-rating.
A re-rating, right.
Yeah.
Because management didn't just report numbers, they confirmed a whole thesis, didn't they?
Exactly. Accelerating revenue growth and superior operating efficiency. They showed they could deliver both.
Okay, so let's jump right into those numbers that caused that reaction.
Yeah.
Q2 2025 looked like a decisive beat pretty much everywhere.
Yeah, definitely signaled an acceleration. Top line first, total revenue, $113.0 million.
Which was way above the street, right? What was consensus? About $108 million.
Roughly, yeah.
Damn.
So a significant beat. That works out to 15% growth year over year, GAAP, or 14% if you look at constant currency.
And the bottom line, I mean, that wasn't just a beat.
No, that was, frankly, a blowout. Non-GAAP EPS hit $0.24.
24 cents. Consensus was down around, what, Steve 11s or 12 cents?
Exactly, more than double. And even GAAP EPS flipped positive, $0.03 this year versus a loss of 5 cents last year.
Okay, and that really sets up the other big piece of the story here.
Yeah.
The leverage.
Right, adjusted EBITDA. It surged 33% year over year, hitting $24.8 million. That kind of margin expansion, it's not typical, and it really underscores the strategic theme management kept highlighting.
Let's dig into that theme then. Operating leverage. It's something they've talked about before, but Q2 really showed them executing on it.
It did. Their stated goal, and they reiterated this, is to grow adjusted EBITDA at roughly twice the rate of their constant currency revenue growth.
2X algorithm.
That's the one. And in Q2, they delivered 33% EBITDA growth on 14% constant currency revenue growth. It shows that structural shifts are really taking hold.
But here's the key question, I think. Is that 2X rate sustainable? Or was Q2 maybe a bit of a one-off, benefiting from easier comps or fixed cost absorption after last year's issues?
That's fair. Is it structural?
Yeah. What locks this leverage in?
Management's explanation is it comes down to scale and their product mix. They're focusing on these high-margin, complex segments. So as their differentiated products like stent grafts and On-X valves gain more traction, that incremental revenue just drops to the bottom line much more efficiently.
Because the infrastructure is already there. Salesforce, R&D, all that.
Precisely. It's not just cleaning up fixed costs from one quarter. It's about a disciplined, scaled operating model taking in.
Okay, that makes sense. And that structural shift relies on product momentum, especially where they have that competitive edge. Let's break down the segments, maybe start with the complex high-margin stuff.
Absolutely. On-X mechanical valves, just a standout performer, up 24% year over year, constant currency.
24%. Wow. What's driving that?
It's strong U.S. performance, definite market share gains, and the big clinical differentiator. On-X is the only mechanical aortic valve that lets patients maintain a much lower INR.
That's the blood thinner level, right? 1.5 to 2.0.
Correct.
So maybe explain for listeners, why is that lower INR number such a big deal for patients?
Well, it's a huge quality of life thing. Typically, mechanical valve patients need really strict high-dose anticoagulation. That means constant doctor visits, watching your diet carefully, and always facing this risk of serious bleeding.
Right.
With On-X, allowing that much lower INR significantly cuts down the bleeding risk, we'll get to the data on that, and just reduces the whole daily burden of managing blood thinners. It's a powerful reason for surgeons to adopt it.
Okay, yeah, that makes that 24% growth feel earned. What about stent grafts? Another strong performer.
Very strong, up 22 to 24%. Again, this is about a highly differentiated portfolio focused on the complex end of aortic repair. Artivion's positioning themselves as the solution provider for the really tough aortic cases. That naturally supports higher margins.
Makes sense. Before we get to the big future catalysts, maybe just a quick word on the foundational businesses, BioGlue and preservation services.
Sure. BioGlue was moderate growth, up 4%. Preservation services, that's tissue processing, up 3%. Management was clear that preservation services was hit hardest by that cyber event last year, created a backlog.
But they're clearing that.
Yes. Critically, they expect that backlog to be totally cleared by the end of Q3 2025. Once that's sorted, they see the business stabilizing and hitting mid-single-digit growth for the full year.
Okay, good. So let's talk catalysts. This is where the future growth story really lies, isn't it? The U.S. launch of AMDS, their aortic arch solution. That's under an HDE. Humanitarian device exemption, big market.
Huge potential. They estimate it at about $150 million annually. And, not a lot of competition there, but we do need to acknowledge the friction in adoption. It's not simple.
Right, the hospital hurdles.
Exactly. For a hospital to use AMDS, you need site-wide IRB approval. That's the Institutional Review Board. Then the Value Analysis Committee, the VAC, has to sign off. And then, of course, comprehensive surgeon training.
So getting traction despite that friction is pretty impressive.
It really is. And maybe the most interesting nugget from the whole call was this profound cross-selling dynamic they mentioned with AMDS.
Ah, yes. Tell us about that. How does that work?
Well, they gave examples. Surgeons get trained on AMDS, which is for the aortic arch, right? And then they literally go back to their hospitals and start adopting On-X valves for completely different procedures.
Interesting. So AMDS acts like a door opener for the rest of the portfolio.
Precisely. It seems to be reinforcing that already impressive 24% growth we saw in On-X. It's an integrated strategy working.
And that On-X growth isn't just the cross-selling, right? There's solid clinical data too.
Absolutely. They highlighted the 5-year data showing an 87% reduction in major bleeding. That ties directly back to that low INR benefit we discussed.
Makes sense.
Plus, they're going after a new market opportunity, maybe $100 million, based on recent data suggesting a mortality benefit for younger patients under 60 getting a mechanical valve.
So using data to potentially change practice guidelines.
That seems to be the goal, yeah. Accelerate adoption further.
Okay, so strong quarter, powerful catalysts firing.
Yeah.
It makes sense they raised the full year outlook.
Yeah, it felt pretty inevitable after walking through the Q2 results. They bumped up reported revenue guidance to $443 million. That means constant currency growth is now guided slightly higher, 12% to 14%.
Up from 11% to 14% before.
Right. And importantly, adjusted EBITDA guidance got a nice lift too. Now $86 million to $91 million. That range really shows their confidence in maintaining that leverage story, that 2x algorithm. It represents 21% to 28% growth over 2024.
And while driving that growth, they also took time to clean things up fundamentally, didn't they? The balance sheet.
Yes, and this is crucial, maybe even a bit overlooked amidst all the growth news. They dealt with those convertible senior notes due next July.
Retired about $99.5 million.
Mostly through an equity exchange, yeah. It simplifies capital structure, reduces complexity, and crucially, risk.
Let's focus on that impact. The net leverage ratio dropped quite a bit, from 4.1 down to 2.2. Why does that matter so much for the long-term story?
Well, you basically just cut your debt risk in half, right? Going from 4.1 to 2.2 is a massive de-risking step. It frees up management focus, less financial engineering, more operational execution. It lets them confidently pursue those complex, high-potential pipeline projects without worrying constantly about the debt load.
Speaking of the pipeline, let's talk about those future projects. Are the key milestones still looking good?
They are, which, again, confirms their execution capability even on the trickier stuff. We should definitely talk about ARTIZEN. That's the Arcevo LSA trial. It's their third-gen frozen elephant trunk device, a full arch solution.
And they got the FDA green light to start the trial.
Correct. Investigational device exemption, IDE approval, they can begin the pivotal trial.
What are the details there? Trial size, timeline.
They're targeting 132 patients across maybe 30 sites. Enrollment should start by the end of this year. Management really emphasized the competitive angle here. It's designed to be simpler, easier to use for surgeons who already do this very complex procedure.
And why is simpler and easier such a big deal in something as complex as a full aortic arch repair?
Because time is absolutely critical in these surgeries. They are incredibly complex, very long procedures. Anything that shaves off time, fewer steps, smoother deployment directly impacts surgical time. Less time under anesthesia, less time open, usually means better patient outcomes.
Which drives adoption.
Exactly. If Artivion delivers a genuinely better, faster mousetrap here, they could grab share pretty quickly.
Okay. And the other big ones we're watching, AMDS and Nexus PMAs.
Still on track. AMDS PMA, that's the full market approval expected mid-2026. Nexus approval, assuming they exercise that Endospan acquisition option, is still tracking for the second half of 2026. And that's backed by really positive 30-day data they presented back in May. Showed something like a 63% cut in major adverse events. That's a very strong early signal.
So we have this picture, structural leverage, cleaner balance sheet, strong execution. How does this AORT story fit into the wider med device sector context right now?
Well, it stands out dramatically, doesn't it? The broad med device ETF, IHI, it's only up maybe 2% over the last year. Artivion, their trailing one-year total return is sitting around 60%, maybe 62%. They're generating serious alpha compared to the sector.
And that clear beat and raise, the leverage confirmation, the balance sheet fix that all drove the immediate stock reaction, that huge overnight jump.
Absolutely. That 24.4% surge from around $32.92 pre-call to close at $40.96 the next day.
Wow.
It really suggests the market now fundamentally buys into this growth and margin story as sustainable, like a new, much higher price floor has been established.
Okay, which brings us to our segment where we look at all this and float an outrageous but plausible trade idea. For experienced investors, of course.
Right. Standard disclaimer applies here. This is purely hypothetical, not financial advice.
So the premise is, the market has re-rated ART. Execution credibility is high, balance sheet is cleaner. What's the trade idea stemming from that?
Okay, so the thinking is that the risk of the stock falling all the way back to that old floor, say the low $30, is now significantly lower. So the trade could be establish a core long equity position in AORT.
Okay, buy the stock.
And then simultaneously sell short-dated, out-of-the-money put options, targeting strike prices down in that low $30 range.
So you're long the stock, but you're selling insurance against a big drop back to those old levels.
Yeah.
What's the rationale?
Exactly. By selling those puts, you collect the option premium, right? That enhances your overall return potential on the long stock position. You're essentially betting that the near-term momentum holds up. The AMDS cross-selling driving on X, the buzz around the ARTIZEN trial starting soon. You bet that stuff prevents a major pullback in the short term.
So you boost your return by taking on the risk that something truly catastrophic happens, which, given their current execution, seems less likely.
That's the calculus, yes. Maximizing return by selling protection against what now looks like a lower probability downside scenario. It capitalizes on that perceived new floor and the reduced short-term risk profile post-earnings and delevering.
Interesting. Definitely sophisticated, built on those structural changes we discussed.
Yeah.
Okay, let's wrap this up. Key takeaways from this really impressive Artivion quarter.
I think it's pretty clear. 1, confirmed double-digit revenue growth, constant currency. 2, that structural commitment to scaling EBITDA at twice the revenue rate the 2x algorithm is real. 3, a much simpler de-risked balance sheet, leverage basically cut in half. And 4, they're doing all this while pushing major pipeline projects like ARTIZEN, AMDS, and Nexus forward on schedule.
It's quite the combination.
Yeah.
So the provocative thought for you, the listener, building on that, given how well management seems to be executing on this EBITDA grows 2x revenues goal, coupling that efficiency with complex pipeline progress, does this position Artivion to become maybe the new benchmark for how to do growth and efficiency in the complex med device world?
Something to watch, and keep a very close eye on 2 things in the near term. First, any confirmation that the ARTIZEN trial enrollment has actually begun, probably by year end. Second, their next earnings update, likely early November. Those are the next real checkpoints.
Definitely. And as always, remember, everything we discussed today is based purely on the public earnings information. It's absolutely not a recommendation to buy or sell any securities. Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.